Okay, good evening, everyone. I think
Really?
we will just start now. And for other people to join us later because we have a lot to cover tonight. Um,
Nake sauna kichukua mwana. Sawa kati ishende.
Ina sekoju mwana. Nake sekoju.
okay, please unmute your mic.
Lakini pia ya mta ba. Kaga ko ya mta. Abin da yake kusa da agoge baki da shi. Ne kuma shi ita ma rigar ka ne a kusa.
Okay. Good evening, everyone. Once again, please confirm if you can hear me. Then we can start.
Yes, sir, we can hear you.
All right, all right. You are welcome once again. And sorry we were unable to have our class on Sunday, due to some unexpected issues that arises. So tonight we are planning to cover all the aspect on accounting for inventories in order for us to move to the next topic. And I believe all of us can see the new icon pack that was shared in the group. So the purpose of it is for us to make sure that whatever we have been learning are in line with what I can release. So I'm pleading to everyone to make use of the materials, read the theory aspects, and then cover some of the calculation parts, the one we have covered so far, and then the one we will still be covered, so that we can both have a basic understanding before we work on it in our class. Our last class, we were able to talk about some of the methods that we use in inventory valuations, where we're able to treat first in, first out, as well as last in, last out. Tonight, we are going to discuss on the weighted average, and then we'll move to economy order quantity, while we explain briefly on just in time, which is the last aspect of accounting for inventories. So in order not to take much of our time, I'm going to start, and I want everyone to pay attention very well. Like Nick mentioned last week, we give definitions for FIFO level, and then we say we have a 3-method approach that we usually use in determining our inventory valuations before we will now treat economy order quantity. Now the question here is, what is weighted average cost? This method is just give a room for where the level our inventory valuations can be determined within the area of when we are issuing the inventory out. And then issuing this inventory out is being issued out at the current weighted average cost, which means this current weighted average cost will be determined in order to, whenever we are receiving a new purchase, in order to recalculate the amount or the price per unit at which each of the inventories will be issued out. Now, the formula that we usually use for weighted average in order for us to issue the inventories is for us to know the total cost of what we have in the stock before. Then we add it together with the costs of the new inventories that we are bringing to the store. Then we will now divide it together with the total unit of inventories that we have in the store, both the old one and then the new one that we just purchased. You know, once we're able to do this, it's going to give us the current average unit cost in which we will use to issue our inventories. Now we have the merit and the merit, which is the advantages and the disadvantages. You know, one of the major advantages of these weighted averages, it helps us to reduce price in order for us to have a smooth cost of goods sold, and then also help us to determine our inventory valuations. And then the second aspect is it is very, very easy to calculate. It is very easy to calculate compared to our first in and first in, first out, and then last in, last out. So one of the major challenges that we usually have there is if you do not understand the basis of how this weighted average works, you know, whenever we are calculating, we are determining the average costs, we'll be having issues if we do not really understand how it works. That is the number one advantages. And then the second one may actually arise when there's an inflation. You know, it will lead to understated the current market value of the inventories. Now, we'll move directly to the exercise so that this explanation that we just give, it will help us to know how the weighted average works. So I'm going to share my working sheets. Then we can start. I want to be fast so that it will not take much of our time tonight. Just give me a few minutes while I share my working sheets. Okay. All right. Okay. Now this is the working sheets. Now let me bring what we'll be working on to the sheets, and then what will be calculated onto. All right. Okay, sorry, this is our question. No, we need to do that. Okay, I'm coming. Okay. Now, what is the requirement? Now, the requirement of this now is for us to calculate our store ledger accounts using weighted average method. Now, solution. Now, one important thing that you need to understand here is once you're able to know the formula to calculate the issuing price, you will not have issues. But if you were unable to understand how to calculate the issue price, that is where we'll be having some challenges. So this question is one of the past questions on the ICANN pack, I think 2022 or 2023 November. So now, like we did the last time, these are the heading that we need to have coming. What is our dates? Dates, then the quantity, the price, which is the unit price, then the total, which is the quantity multiplied by the total. So this one is our receipt. So this one is the receipts. Why this one will be what we issue out. Now remember, we still need to repeat the same thing. The key point here is make sure that you be able to know the headings. Once you're able to know the headings, then the other aspects balance. This one is a balance. Okay. Now, the question says on the January 7th, the company were able to purchase 2005 units of a particular product. Let me just say they were able to purchase raw materials for Victory. Now, on the 1st of January, they were able to purchase 2005 units. At what rate? They were able to purchase it at the rate of 3 naira. At the rate of 3 naira. Now, you will now come here on the 7th January. Now, what did they purchase? 2005 units. You know, just see. And then they were able to purchase it at the rate of 3 naira. You just come here and put 3 naira. Then, how are you going to arrive at your total costs of purchasing this order? 2005 multiplied by 3 naira, then it will give us 7,005. Then you come to this balance. 2005 quantity worth 7,005. So all these things are just the normal procedure that we usually follow from the first, the first approach that we use. So where the issue comes in here is whenever we want to issue out, because that is where we now formula here. So on the 7th of July, now they make another purchase of 2005. Now you need to pay attention very well here. July to another 2005. Now at what rates? You know, the first one they purchased was at 3 naira, but this one is at 3 naira to 3 naira to kobo. Then you multiply this one for you to get the total value. Then we'll have to come here. And then they purchase another 25 of 8,000. Now, this is where we have work to do. Now, what is the total value of the goods that we have in stock? This one plus this. It means as of July 7th, the company have 5,000 quantity of these particular products in their store, which value at 15,500. It value at 15,500. Now, on the 7th of October, you're supposed to be on the 7th. Supposed to be on the same 7th. On the 7th of July, the issue is where we need to be very careful whenever we see this kind of questions. Remember, weighted average said we issue at the current average costs. You know, it's different from the two first approach that we use, where we issue at the first value of the product that comes to the store, and then the last I'll say we issue at the last unit of the product that comes to the store. But in this case, is different. So in this case now, we need to know what is the total cost of what we have in the store, and then what is the total units of what we have in the store, and then we will not divide the total cost of the product we have in the store divided by the total units of the inventories that we have in the store to arrive at our current average costs before we can issue out any units of products or any unit of inventories for productions. Now you will now come here and say on the 7th they issue out 2,000, then you come to under your issue 2,000. Now how are we going to get the units price at which they issue out these then it's very simple. We'll just come here and then apply our formula. Then what is our formula? Remember, this is the formula here. You know, this is the formula we need to have in our head. You just say weighted average costs. Weighted average costs. Costs. Then you come here, you say, what is our total of existing inventories? You know, our total of existing inventory is 7,005. And then plus the cost of the newly acquired inventories. Now, the last inventories that the organization brought to the store was on the 1st or the 7th of July, which is 2,005. 2 kobo, which value at 8,000. Now, if you look at this place now, we have already valued our total cost of inventories, which is 15,500. Then you come to this place. What is our total unit of the inventory that we have? The old one and the new one that we just brought to the stock is 5,000. You know, the unit price at which we are going to issue out our inventories. Now, if you carry your calculator and divide it, 15,500 divided by the 5,000 units that we have, now is going to give us 30 naira. Going to give us 30 naira 1 kobo. It means whenever we are issuing out this 2,000 quantity, it should be issued out at 3 naira 1 kobo. It should be issued out at 3 naira 1 kobo. Now, what we are going to do, we just multiply these 2,000 units multiplied by 3 naira 1 kobo. Now, this is the value of what we issue out. Now you come to this place now. The total inventory that we have in stock before is 5,000, and then we issue out 2,000. Now it means in the store now, what we have left is 3,000 units. At what value? You know, you can use two approaches, but to be on the safer side, just do this: 15,000 minus 6,000 is going to give us the value of what we have in the store. But on another side, if we want to check if this is actually correct, remember that the value of what we are issuing this thing out is 3 naira 1 kobo. You can just say 3 naira 1 kobo multiplied by 3,000. So it's still going to give us the same value. So either way that you use to determine the closing inventory as at when you issue out, the closing value as at when you issue out, you are still going to get at the same thing. Let me leave this one here. Then now let's go to the second aspect. Now on the 19th of July, the company decided to issue another 2,005 of the inventory to their production units. Now you come here on the 19th July. Then how many did they issue? They issue out 2,005. Now, very simple, put it here. Remember that at this point now, they have not bring in any new inventories. So we are still going to maintain the same unit price that we use to issue out our last issue before this new one that we want to issue out. So what you are just going to do is just put your 3 naira 1 kobo here, then you multiply it for your in order to know the total value of what you issue out. Now the total value of what we issue out now is 7,750 naira. Now we come here, we'll say this 3,000 minus 2,005. Now it means in store now we have 5,000 units of inventories left in the store. At what rates? Now you come to this place. Remember the two approach, but the simple one, I'll just say this, the value of what they have before the issue, the value of what they issue out now. Now it means in the store now we're having 500 inventories, 500 quantity of our products in the store presently now at the value of 1,550. So I hope we are getting this explanation. Now we go back to our question. Now on the 21st of July, the company decided to purchase another value. They purchased 3,500. Now at what unit price? At 3 naira 3 kobo. Now you come to this place on the 21st, on the 21st, come here on the 21st July, 3,005 at what rates? 3 naira 3 kobo. Now what is our total value? Very simple, though the same approach that we used in the last class. It means the value of what they purchased, now let me copy this and bring it down, is 11,550 naira. Now in the store they have 500 units before, and then they decided to buy another 3,005. So it means in the store now they will be having of these particular products in the store. And then at what value, then you bring this one. Now remember the first approach that I did here to arrive at this value. The same thing will also be determined here too. Now in the store now we are having 4,000. And then at what value? This plus this plus this now. Okay, this plus this. Let me go this one. This plus this. So how do we arrive at this 13,100? Very simple. Before we are having our closing inventory as at on the 19th July is 1,550. And then on the 21st of July, they decided to bring in another 3,500 units of products at the rate of 3 naira 3 kobo, which the total value is 11,550. Now, what are you going to do? The old one with the new one, you add them together. But whenever you want to issue out, that is when this weighted average approach comes in. That is when it comes in. Now, you will now go back to the questions. On the 28th of July, the company decided to issue another 2,000 units. I think that is the last unit for the month. Now you come here, 2,000. 2,000. Now, at what rate are we going to issue these things out? The same approach that we use here is what we are still going to use. Now, we will now say our total cost of the product we have in the stock, which is 13,100, then divided by the total units of what we have. So how are we going to do this? If you have calculator, then you can do it. 13,100 divided by 4,000 units. So it means we are issuing out these 2,000 at the rate of 3 naira 275. So you now come here 3 naira 275. Now, what is the total value now? 2,000 multiplied by this. Now, it means we are issuing out 2,000 units of this inventory at the rate of 3 naira 2 kobos and 75 3 naira 0.275 kobo. Now, if you watch this carefully, our issuing price changes. Why is it changes? The approach here is whenever we are bringing in the new products and then we want to issue out a product to the production units, we value our issue out inventories at the average costs of what we have in the store before and then the new one that we bring in. We determine this average cost by knowing the total value of what we are in the costs in the store, and then what is the total units of the inventories that we have in the store as at the time that we are issuing out. Then we will now use those two aspects, those two key points to determine our current weighted average to issue out the inventories to the production units. So that is the reason why we are having different issue unit price per unit here. You know, unlike the FIFO where we have to use the price of what we have in the store before, and then the last other approach, we have to issue the inventories at the price of the new inventory that we bring into the store. But in this I area, is totally different. Totally different. So that is the reason why we are determining the weighted average by using this formula. What is the formula? You know the total value of what you have in the store, and then know the total quantity of the inventory that you have in the store. Then you divide the two together to ascertain your current average cost, and then you use it to issue out your inventories. Now, after we are issue out another 2,000 from the 4,000 that we have in the store, how many do we have left in the store? It means we are having 2,000 left in the store. At what value? This minus this. So now this is our closing inventories. Let me move it down. This is our closing inventory. Now this one is very simple, unlike the last in, last out, and the first in, first out. Once you are able to closing balance. Now this is our closing balance. And then, like I did from the last class, where we're able to know the total value. Okay.
Sure.
All right.
So I just wanted to understand the 6550, how we came about it. I guess I skipped that part, like my eyes was not on that part. The closing balance, I mean.
The closing balance. All right. You know what we did here? This is the closing balance before we decide to issue out another 2,000. And then in the store, we have 4,000 quantity of the inventories. Now we decided to issue out another 2,000 at this issuing price, which is the current average price that we determine by the total value of what we have in the store divided by the total quantity of the inventory that we have in the store. So that is how we arrive at this issuing total. And then how do we arrive at this closing balance? Remember, I said you can determine your closing balance in two approaches. The first approach is minus the closing balance that you have before you issue out from your new issue value, which is like this. You have 13,100 in the value of what you have in the store before, and then the value of what you issue out is 6,550. So it means if you deduct what you issue out from what you have in the stock before, you are going to close with 6,550. That is number one. And then you can also decide to use the second approach, which we are still going to get the same value. We said we have 2,000 left in the store. Okay, 2,000 left in the store. And then the current average, weighted average price that we determine to issue our products, then we'll multiply it with the total inventory that we have, which is this. We are still going to arrive at the same thing. But to be on the silver side, if you are in the exam, so that it will not get confused, just decide to minus this, the total what you have in the store before, from the total of what you issue out. You are still going to get the same thing. So I believe you get this one correctly. Now, any question before we move to the economy order quantity? Any question on this? So if we do not have any question, then we'll move to next method. So okay, let me reshare my screen then, because this one we still have like 2 calculations to do. That is why I'm trying to be fast so that we can both be on the same page. All right. Okay. Now this is another method of inventory valuations. The purpose of this economy order quantity is to help an organization to reduce the cost of bringing in their inventories into the store. You know, every organization have an approach on how they decide to be buying their productions, their raw materials. This economy order quantity give them the avenue to come up with an easy way to minimize the cost, the total cost of inventories, the total cost of bringing in the inventories into the store. And then economy order quantity has a formula that we need to understand very well, because you having this or you having this formula in your head will help you to break down whenever you see question relating to EOQ. Now, this is the formula. Here we say Q. You know, this Q stand for EOQ. No, then you put it into a square. This 2 is constant. Then we have a CO multiplied by the D all over CH. Now, what is Q? Q simply means the total quantity that the company budgeted to purchase every year. While the CO stand for the fixed cost per order. You know, every organization decided to have the cost per order that they will incur whenever they want to bring in their inventories. And you know, well, whatever that is fixed, it has to be fixed for a certain period of time. While the CH stand for the cost of holding the inventories per unit. It means for you bringing in every unit of inventories into your store, you are spending ₦1 to bring in 1 unit into the store or into the your factory. That is what the CH stand for. And then the D stand for the annual demand. So the annual demand is what you budgeted for every year to bring into the store. While the Q stand for, okay, I budgeted for 20,000 every year. How many times did I need to bring in these 10,000 that I budgeted? If it is 5 times, then how many units did I need to be bringing into the store to cover these 5 times that I budgeted? So that is where the benefit of EOQ actually comes in. It helps us to come up to know, okay, there are the other level costs, or the other level approach, and then there were holding cost approach. And then also, please unmute your mic, please unmute your mic. So now let me reshare my screen so that we can do some calculation. Then you can get my explanation very well. Okay, give me 1 minute, please. Give me 1 minute. Okay. Give me 1 minute, please. All right. Okay, sorry. Just give me 1 minute. I'm having issue to copy this question. I've done that. So let me just highlight it. Give me 1 minute, please. Now, okay, required. Calculate EQ, then determine the reorder costs, then determine the coding costs, then calculate the total costs. Now, let's start. One thing that should always come to your mind is, what did they ask us to do here? The purpose of this is to help an organization to minimize the costs of bringing in their inventories. Then how can they minimize it? That is when this EOQ comes in. Now, this is our question. Now, let me try to fix it so that we can be seeing the question. Okay. Now, the first question said we should calculate the EOQ. Now, what is our formula? The reason why we need to calculate this EOQ is to know at what units do we need to be bringing into the store in order to cover our total unit for the year. Now, let's look at this question. The company use, is 124,000. The company use says 124,000 units of material each year. It means for the company to carry out their production area, they need to, please unmute your mic, please. Try to unmute your mic, please. Who is that? Okay, the company uses 140 units of material each year. So it means every year the company uses 140,000 units of material each, which costs 250 naira per unit. It means each of the units of this material each costs 250 naira per unit. And then the cost of placing an order is 5,000 for each order. Now, for the company to place each order for this material age, they need to spend 5,000 for each order. Even if they decided to bring in 1 unit into the store, they are going to spend the same amount of order cost, which is 5,000, regardless of whatever they are bringing into the store. Now, the annual cost of holding inventories each year is 10% of purchase price of the units. Now, the company now decided that, okay, the cost of holding each of these inventories is going to be 10 naira per unit. You know, holding cost means the cost at which the organization is going to be keeping those inventory into their factory, into their stores. So every organization have to plan for such costs whenever they are bringing in materials into their factories or into their store. So in this aspect, the company decided to budgeted their holding costs at 10% of each purchase price of this material H. Now, the question here is, remember our formula said 2 COD and then divided by the H2. Now, what is our CO in this question? Our CO stand for the placing an order, the cost for placing an order. Now you come here, CO is equal to 5,000. Now I want to break the question down, then we'll be able to calculate each this with ease. Now, what is our D? Now our D said is our annual demand. What is our annual demand? Our annual demand is 140,000 units. 140,000 units. Okay, units, sorry. Units. Now, what is our CH? Our CH here is going to be 10% of our purchase price per unit. Now, 10% of how much is our purchase price per unit is 250 naira. Now, 250 naira now is going to give us 250 naira divided by 0.1. Now, it means for every unit of material H that we are bringing into the store, the company have budgeted the holding cost of 25 naira for each of the inventories or each of the material H that they are bringing into the store. So now we have simplified.
Sorry, sir.
Okay.
Sorry, sir. Please, can you throw more light on how you got the 250 and then 25? I think
All
I'm
right.
lost there.
Now, if you look at the question very well, they say costs per unit of material H. The purchase price of unit of material H is 250 naira. It's from the question. 250 naira per unit. So whenever they are purchasing material H from their supplier, they are paying 250 naira for each of the material H. Is from the question. You can see it here. It's from the question. Then how I arrive at this 25 naira. The company budgeted the holding cost to be 10% of their purchase price per unit. It means whenever they are bringing in each unit of products or each unit of material H into the store, they budgeted the holding cost for it at 10% of the purchase price. Even if purchase price is 300, the 10% is still going to be charged on the 300. But in this case, our purchase price per unit is 250 naira. Then, whenever they are bringing in each of these material H, they have already set aside the holding cost to be 10% of it. So that is the reason why we now say 250 naira divided by 10. You see, it's give us 25 naira. That's how we arrive at 25 naira. It means any amount of the material each that we are bringing into the store, our holding costs is going to be 25 naira per each. If we bring 10,000, we are going to multiply that 10,000 with 25 naira. As we are solving this question, you get more light on how this work. Now, let's now calculate our EOQ. What's the, okay, now remember this is the formula that we are using. So let me see how I can try to bring in this formula so that we can understand how to use it. Okay, let me use this. Let me use this to understand how we are going to use it. Okay. Now, the formula said 2, our 2 is constant, remember? Multiply by the CO. What is our CO? Our CO in this question is the cost of placing an order. And our cost for placing an order in this question is 5,000 naira. Now you will now say multiply. No, let me just put this X as multiplication. Multiply by 5,000. Then what is the next? The next is our annual demand, which is our D. Our annual demand is for 140,000. 140,000. Now divided by HC. What is our HC? Our HC here is 25 naira. Now we are going to calculate this so that we can know the quantity at which the company can place their order. Now, if you have calculator there, you will do it. Let's do it together. 2 multiplied by 5,000 multiplied by 140,000 divided by 25. Now it's going to give you 56 million. Now this 56 million, we are using square root. You now go to your calculator and press square root. Once you press square root, it's going to give you 7,483.31 units. Okay, so what this signifies is for this company to meet their annual target of 140,000, it means they have to be placing 7,483.31 units of material each. For them to meet these annual targets, they have to be placing 743,800. Sorry, 743. 7,483.31 units at every order they are placing it. Now we want to decide, okay, we want to place 7,483 units. At how many times do we need to place it in a year to meet the annual budget of 140,000? That is when we need to determine our reorder cost approach. Now, how do we determine the other cost approach? You will now say the other costs, the other costs. Now, the formula for the other cost is D divided by Q, D divided by Q. Now, in this question, what is our D? Our D is the annual demand, which is 140,000. Then divided by Q. Our Q is the number of units that the organization needs to place in order to meet this annual demand of 140,000, which we have already arrived here. You will now say, you come to this 7,483.31. Now, you will now divide this 140,000 divided by 7,483.31. Okay, let me make these 2 decimal points. Okay, now it means for this company to meet their targets now, they have to place 7,483 units 18 times. Now, if you like, you can decide to approximate it and make it 19 times. Let's just approximate it and make it 19 times. So, for this organization to meet their annual demand, they have to place these 7,483 19 times to meet the annual demand. Now, how much are they going to spend in placing this order? Since they are going to place this order for 19 times, how much are they going to spend to place this order for 19 times? Now, you will now come here and say our cost per placing each order is 5,000. Remember, that is what we have here. You will now say 5,000, which is the cost of placing order, multiplied by the 19 times in which they are to place this order. It means if the organization decided to purchase this order 19 times to meet the annual demand, the total placing costs they are going to incur is going to be 19,000. So the purpose of doing this is just to minimize our costs. Now, we have determined our other costs now. We have determined the other costs. Now, let's go to the holding costs. Now, holding costs. Holding costs. The formula to calculate holding costs is Q divided by 2 multiplied by CH. Our CH means our holding cost per unit. Now you will now come here. Now we have already determined the units of the number of products that we need to place, which is 7,483 units. Now you will now come here, 7,483 units divided by 2. Divided by 2, then multiply by holding cost per unit. Now, what is our holding cost per unit? Remember, we determine our holding cost per unit here to be 25 naira. Now our holding cost per unit here is 25 naira. Now you want to know how much are they going to spend to hold these costs in their factories. That is the reason why we are coming up to determine these holding costs. Now, you will now say 7,483.31 divided by 2. Okay, it's equal to 783 divided by 2. Okay, divided by 2. Now, this is the average units now. Then we now multiply it by this 25, multiply by 25. Now you see now. For us to bring in this 140,000 units of material H, our holding cost is going to be 93,541 naira 38 kobo. That is the total cost that we are going to save in bringing in these products. You know, the company might decide to increase their units per order. You know, that might actually come when maybe an organization decided to give them some discounts to encourage them to purchase more in order to meet their annual demand. You know, we'll still get to that place. Now that we have determined our reorder costs and then we have determined our holding costs, now we need to calculate for the total costs at the end of the year. Now, how are we going to determine that? Firstly, you have to first determine the purchase costs. Okay, now that we have determined our reorder level, you know, the cost that we are going to incur whenever we are bringing in all these materials, and then the cost that we are going to incur whenever we are saving, whenever we are bringing in the material into the store, the cost that we'll be using it to save the material into the store, which is the holding cost. Now, how much are we going to spend to for buying these productions? What is our purchase costs? What is going to be our purchase costs? Now, remember, the total units that the organization planned for the year is 140,000 units at the rate of 250 naira. Now, we will now say the total units budgeted for annual multiplied by the purchase price per unit. Okay, or HK. So it means the purchase price per annual is going to be 35 million. Okay, now that we are determining our purchase price, how much is now going to be our total cost at the end of the period? You know, in order for me not to forget, let's add these two up. Total costs minimized. You know, you just add these, the other costs plus the holding costs on HK. Now this is our total cost minimized. Now our total cost for the period now is going to be the purchase costs plus the costs minimized, Now, what is our purchase costs? Is 35 million plus these total costs minimized. So it means at the end of the period or at the end of the year, the total amount that the organization is going to spend in bringing in this material age is going to be 35,188,541 naira and 38 kobo. So in these aspects now, it's just to help an organization to structure when and how do they need to bring in their materials.
Sorry, sir.
And then how can they minimize the cost of bringing in this material into their store or into their factories? That is the purpose of why the other level quantities is very important, most especially maybe in an organization where, most especially in the manufacturing organization, where some of their inventories are having a very limited life span. They need to, an organization need to come up with the other level approach on when and how do they need to bring in their inventories. As we are moving to the next level, there's another one that we call a buffer. In this level now, we do not need it for now. I will not go in deeply into that aspect. What we
Excuse
just
me,
need here
sir.
is all right.
I think Mr. Aliyu Abubakar has a question. So he has been trying to reach you. So I think you didn't hear him.
Okay. Mr. Lee, you can go on.
Sir, please, how do you get this total cost minimized?
Okay. All right. For you to get the total cost minimized, or the total cost at which an organization needs to incur to bring in their materials into the stores, is for you to determine your reorder level costs plus your holding costs. So once you're able to determine the reorder level costs and then the holding costs, is going to give you the costs at which you are going to save your inventories whenever you are bringing them into the store. So now, how do we arrive at all these things? You need to understand the formula that we are using. The reorder costs formula say D divided by Q. What is our D? D stands for total annual demand. While Q stands for the total units that an organization decided to come up to meet the target annual demand. It usually come up in a situation whereby you have to structure on how you intend to be bringing in your materials based on the demand of the customer can decide it, and then you can also structure based on how the materials that an organization is using to make their productions. That is where we apply this formula of EOQ. No, the purpose is just for us to know the total units of what we need to be bringing in to meet our annual demand. So whenever you are calculating for your other costs, just remember the formula D divided by Q. Your D stand for the annual demand, and then Q stand for the quantity arrived when you are applying your EOQ formula. Now, the holding costs as well is the cost that you are going to incur to keep those materials into the store. Now, every organization has to come up with those cost structures to minimize their costs. Now, how do we arrive at this total minimized costs? The cost that you get from the other level costs plus your holding costs is going to be the total costs minimized in bringing in the materials into the organizations. So I hope I was able to answer your question, Mr. Abdurrahman.
Yes, sir.
Are you with me? Okay, did you get the explanation correctly?
Yes, sir. Thank you, sir.
All right. So now,
Yes.
the purpose of all this is just to help an organization structures the level of how they will be bringing in.
I got you.
Okay, how they will be bringing in the materials into the organizations, and how can they minimize the costs. Now, what if the supplier decided to give discounts? What if they decided to issue discounts to a company to help them purchase more at the reorder level period? Now, suppliers usually use these quantity discounts to convince their customer in order for them to buy more. To encourage them that, okay, if you are able to purchase, maybe the organization structure to purchase like 5,000, and then the supplier now try to convince them that, okay, if you're able to purchase like 7,000, we are going to give you certain discounts on the 10,000 or the 7,000 that you are going to purchase. But if you decided to purchase at the same level that you have already budgeted, you are not going to get any discount. Now, it's not left to the company to now come up with, okay, should we go in line with what our supplier demand from us by giving us a certain discount of whatever we are buying? Now, in this same scenario now, that the purchase price per unit is 250 naira, and then they might decide to give them like 5% of this purchase price per unit, or they might decide to just give them like, okay, if you are buying this certain quantity and above, we are going to reduce the purchase price per unit with 2 naira, with 3 naira. Now, the organization will now try to re-strategize that, okay, if we decided to purchase these materials based on our cost structure, how much are we going to spend? And then if we decided to follow the discount approach that the supplier intends to give us, how much are we going to spend? every organization always try to minimize costs. Now it's not left to organization that whenever they decide both, they will now go with the lower price, the one that have the total lower cost and the end of calculating the both side, the one they have already structures, and then whenever the supplier decides to give them some discounts in buying a number of units of materials. Now, in related to these questions now, the supplier offer a price discount of 6 naira to this company if they decided to order from 11,000 and above. Remember, based on the company structures, the company have already structures that they are going to be buying 7,483 units at every order level for 19 times to cover the annual demand of 140,000. But if they decided to now follow the discount that the supplier offered them, how much is our total cost is going to be? Now, we are now going to calculate for it the amount they are going to spend if they decided to follow the supply order from 11,000 and above. So in this case now, the first thing that you need to do is how much are we going to be spending? How much is going to be our cost of placing of placing this order of 11,000 unit and above? That's the first thing that you need to calculate. Now remember, we say our order costs is D divided by Q. Now this stands for our annual demand, which is 140,000. 140,000 140,000, while our Q is the amount of the order the supplier have already given us to purchase, for them to give us a discount on the units or on the purchase units price, now which is 11,000. Now we need to now divide this to know how many times do we need to purchase these 11,000 to meet our demand. You will now say 140,000 units divided by the 11,000 units they propose. Divide 140,000 divided by 11,000 units. Now it means instead of the company to place their order for 19 times, if they want to follow the discounts that the supplier is going to give them now, they are only going to make 12 times order. We can approximate it to 13 times order to meet their annual demand. But how much are they going to spend for the other level costs? Remember, our reorder level cost in this question is fixed. It is being charged at the rate of 5,000 naira. So what are you going to do here is just multiply the order level costs by the number of the order that they are going to make So it means the the order level cost that they are going to spend to bring in this annual demand based on what their supplier have already given them is going to be 63,636 naira. Now, one thing that you need to understand in this reorder level cost is whenever an organization decided to increase their reorder level period or the total unit of what they are going to order for, the reorder level cost will reduce. It means the reorder level time is going to reduce. As the order level time is reducing, the cost of placing this order as well is going to reduce. Before they plan to place this order for 19 times in a period, maybe within a year, by purchasing 7,483 units at every order level. But the supplier decided to give them some opportunity to increase their reorder level. Now, their reorder level period now decreased to 13 times if they follow the approach at which the organization, the supplier give them. The more the reorder level decrease, the more the total cost of the order level is going to decrease. You need to understand that aspect very well. Now, we have come up with our reorder level cost. Now, how much is going to be our holding costs? Now, remember our holding cost formula is Q divided by 2 multiply by CH. Now, this is where we need to pay more attention. We need to pay more attention here. Now, our Q is 11,000. Our Q is 11,000. 11,000 divided by 2. 11,000 divided by 2. Now, our ordering cost before, if we did not follow the discount that the supplier is going to give us, is 25 naira per unit. That is what we determine when we are calculating based on the structures of the organization. Now, in this case now, the supplier decided to give them the discount of 6 naira from the purchase price. And then the company have already placed the cost of holding costs on the purchase price per unit at 10%. And then this discount is going to affect our holding costs because we need to determine how much are we going to pay per unit cost if we decided to follow the supplier orders by giving us these discounts. Now you will now come here, you will say, okay, purchase price per unit is 250. It's 250. But the company wants to give us 6 naira as discount if we decide to purchase 11,000 and above. Now you will now come here and say, okay, 6 naira. If they decide to give us the discount of 6 naira, now it's going to be this minus 6 naira. It means this is the purchase price per unit. Price per unit that we are going to be paying for each of the units that we order, that we are going to be ordered based on what the supplier decided to give us. Based on what they decided to give us. Now, how are we going to get our holding cost per unit? Very simple. Remember, the holding cost per unit is 10% of purchase price. Now, we just do this price per unit, since we have already removed our discount from it, divided by 10%. Now, which is a 0 points. Okay. Now, it means the cost per holding cost now is going to be 24 naira 4 kobo. You know, you can see the differences now. Here now, without having the discounts from the supplier now, our holding cost per unit is 25 naira. But when they decided to give us the discount of 6 naira, our holding cost per unit too is affected. It's reduced from 25 naira per unit to 24 naira 50 kobo per unit. Now, we will now come here and say this 11,000 units divided by 2. Now, multiply this average by the holding cost per unit. So now it means our holding cost now is going to be 134,200. Our holding cost now has already been affected by the discounts that the organization decided to give out. Now our holding cost, it reduces. It reduces. Now you will now say our costs, our total costs minimized. Now it's going to be our holding costs plus the total, our holding costs plus the total holding costs. Now this is what our total cost per unit is going to be. Then what is going to be our purchase price? Our purchase price is total annual demand, which is 140,000, multiplied by the price per unit. Remember, our price per unit, we have already arrived it here to be 244 naira, since the company, the supplier is giving us 6 naira as the discounts. Now you will now multiply it by this. Now it means our purchase price have coming. Okay, I think this one. Okay. Now our purchase price now is 34,160,000. Now, if you look very well now, our purchase price here increase. In this case now, we are not having discounts. But when we are having discounts, our purchase price reduced. Now, what is going to be our total cost? Remember, our total cost is the total purchase price plus the costs minimized, which is this. So it means if we decided to follow the supplier order, by ordering 11,000 per each order, our total cost is going to be 34,347,836 naira. Now you see now. But if we decided to follow our own structures, our total cost is going to be 35 million. Okay. Our total cost is going to be 35 million 188,541 naira. Now, the purpose of this EOQ is just an help an organization to minimize costs. Now, when we receive discounts, and then when the total cost, when we did not receive our discounts, will come in. When we did not receive our discounts. Now you see now the differences now. See the differences now. When we do not receive discounts. Now it's not left to the organization to now decide now. The purpose of this is now is just to help an organization to minimize costs. Now that the organization have already come up with the two approach, that okay, if we decided to follow our own structures based on what we decide to be purchasing at every order, which is 7,483 naira, that we are not going to receive any discounts, or we follow what our supplier gives us by placing our order at 11,000 units of material H at the discount of 6 naira on each of the purchase price per unit. What is going to be our total costs? Now you see the differences now. So the organization now will now go with the lowest total costs, because that is the reason why we are doing all these things. The purpose is just to make sure that they help an organization to minimize the inventory costs. So if we receive discounts, our inventory is going to be reduced from this 35 million to 34 million. It means an organization is going to save 830,000 if they decided to receive the discounts. But if they decide not to receive the discounts, they are going to pay 35,188,000. I believe we understand this. So if you have any question at this stage, please ask the questions, because this is where we will be stopping today. Just unmute your mic and ask question, please.
Sorry, sir. My
right.
phone malfunctioned. I could not get the holding cost for this one now. This discount. The holding cost for it.
Okay. Now, if you remember the formula that we are using, we say Q divided by 2 multiplied by the CH. Our Q stands for the total unit that we are placing per order. We are going to divide it by 2, because we are going to, the reason why we are dividing it by 2 is just to determine the average of it. Then multiply by the CH. The CH stands for the holding costs per unit that an organization have already been decided whenever they are placing each of the order. But in this discount now, the supplier decided to give them 6 naira on each of the units of the materials. Remember, the price per unit before is 250 naira per unit, and then they decided to give them 6 naira. Now it means what the organization is going to pay per unit now is going to be 244 naira per unit, and then the company have already set the holding costs based on the purchase price. Now that they are giving us the discounts, and then our purchase price per unit have reduced from 250 to 244 naira. So it means our holding cost now will be affected by dividing this new holding cost after we have received the discount by the percentage, which is the 10% percentage that the organization have already set aside to determine their holding costs. Now you will just say this 244 naira divided by 10%. Now it means each of the holding cost per unit is going to be 24 naira 4 kobo. 24 naira 4 kobo. Now you will now come here. Remember, we are applying this particular formula, Q divided by 2 multiplied by HC. Now our HC in this aspect now is 24 naira 4 kobo. Now you will now say 11,000 units divided by 2 multiplied by 24 naira 0.4 kobo. Now you see now, it means the total holding cost for the period now is going to be 134,200 naira. That is what we arrive here. I hope you get how we arrive at the holding costs.
Yes, sir. Thank you very much, sir.
All right. So another question, please, before we call it the day. Okay. Okay. Now that there's no question, now we are rounding up on the accounting for inventory. No, I'm not really too feeling fine. So that was the reason why my force was a little bit down today. So, and our next class, we are going to start from accounting for labor, where we'll be able to determine how can we determine the cost for labor. You know, the one we have been determining before is the cost for material for inventories. So in our next class, we'll be determining what is our accounting for inventories. But before we close for today, there is a last subtopic under accounting for inventories, which is called just in time. You know, the purpose of this just in times is just to help an organization to minimize inventory that they had based on the category of their inventory levels. You know, we have 3 types of inventories. You know, we have a finished goods, we have working in progress, and then we have raw materials. So the purpose of just in time system is just to make sure that the organization have a short production period so that the goods can meet the demand of their customer whenever they are making their productions. So I'm going to share some materials that we will read on it. And this is where we'll be stopping today for today's class. So thank you very much. And have a lovely night. In case we do not have any class, so we'll be ending our class today. And thank you for joining the class. And we are going to have our next class on, I'm thinking maybe on Friday. If Friday will not work, then we are going to schedule it to the normal Sunday the class usually would. So good night and have a lovely night. Bye bye everyone. Good night.
Welcome.